everyone, this is Semantics Research with your daily market recap. Looking at the ES, we had an inside day in the previous range with weird volume structure and wonky tape. We had value down less than 1% today, showing that it is continuing its preservation of capital this month and year in the current situation of global economic slowdown or recession with high inflation. Value is down 2.11% the past month and 4.93% year to date. Growth, on the other hand, performed poorly today, down 2.41% as money is continuing to leave risky equities into safer asset classes and equities such as value, defensives, and the dollar. Growth is down 6.56% the past month and 22.33% year to date. The best performing sectors for this year have been energy and utilities, which are actually both connected to each other. The utility sector relies on supply from energy for their business, such as electricity and natural gas. The energy sector is generally cyclical and high risk, as it is heavily sensitive to commodity prices and political events, while the utilities sector is defensive and stable, as it has less volatility than the market overall. The current economic situation has been strongly beneficial to these sectors, as we have had energy prices soaring this year due to supply chain constraints, sanctions on Russia, and inflation, and we also likely have a macroeconomic downturn ahead of us. Many of the biggest companies, such as Walmart, see these problems being persistent and problematic this year. Overall, this year, we have had risk equities, such as those in technology and consumer discretionary sectors, performing the worst this year because we are in an economic slowdown and possibly a recession, which is the worst case scenario for high risk investments. We have seen a decade of low interest rates due to the deflationary effect of technology sector with Moore's Law, which was a catalyst for a decade of growth, outperforming value, and the technology sector dominating. Then in 2020, we have had shutdowns in the global economy, which led to supply chain constraints and high unemployment rates. We were in a very deep recession, so the Fed printed money like there was no tomorrow to save the economy in the short term at the expense of the future. Overall, it was obvious looking at the economy that we would have very high inflation from the state of the world and how the Fed handled the situation. Then the CPI started to show that inflation is a massive problem, and the market interest rates responded, with Treasury yields rising across the board. We have had short-term Treasury yields such as the 3-month T-bill rising 2,000% year to date, while long-term yields such as the 10-year T-note rising just 81% year to date. So we have had many yield curve inversions and flattening across the board. This is a very bad sign for the markets, since when the yield curve inverts, it means that investors are fearful of the future and are expecting short-term yields to rise and long-term yields to fall. This means that in the short term, it will be riskier to invest in the markets, and investors expect higher rates of return to compensate them for taking on more risk, cutting into companies' valuations. This will affect higher risk companies more than more stable companies. We have seen that happening this year generally, with money going into defensive sectors and value stocks over risk sectors and growth stocks. Also, the way the Fed has handled not only 2020 situation, but the 2022 inflation situation has been very bad. They have been too soft on the rate hikes to start the year, so the market had to do the heavy lifting for them, bringing down bond and stock prices. Now the Fed is behind the curve with these assets already down so much. They did not do enough to fight inflation, as they were hoping for a soft landing, like they were saying before in the past that inflation is transitory. Now they must be overly aggressive in fighting inflation because of their mistakes, and will need to raise rates much higher and reduce their balance sheet faster. This puts them at a much higher risk of starting a recession if we are not already in one. Many talking heads in the media are saying that this is the bottom, but most companies and financial institutions are very bearish this year. It is not looking very good at the moment with the Fed making so many mistakes and losing credibility, which can amplify the problems even more, as well as the state of the global economy. But if the Fed does manage to pull off slowing down inflation without causing a recession, it will be bullish and we could have a very strong recovery. It is crucial to keep our eyes and ears open to how the Fed is going to continue to handle the situation moving forward. We also had the BLS unemployment rate for May come out today at 3.6%, which was the same as the last 2 months, so it is not much of an impact on the markets as it was in line with what was expected. June 13th is an important date because it is before the FOMC and it is options expiration for the VIX, which should make it a volatile day for the markets. The market is currently well hedged with SPX puts and VIX calls. They were selling VIX before, which made it contract, and there has been less put buying in the last few weeks. We're massively oversold and had momentum buyers buying not much put inflow, and when people start buying puts, it will tank the markets as markets are put driven. Thank you for watching the video, and be sure to check out our description for links to our social media.